Welcome back, everybody. Our topic today, tax treatment of option trades. This is your host, Dr. Paul Price, for Options Profits. Option trade reporting rules are not always intuitive. They have to be followed exactly according to IRS regulations. It's not just the way you think they should be. They are mandatory. The IRS requires you to report your option trades in any taxable account, and they're quite detailed in how they have to be done. We're going to cover some, but not all, of the tax treatment for options transactions today. If you're an option buyer, things are relatively straightforward. Short-term and long-term is the same as with stocks that you own. Anything up to a one-year holding period is a short-term gain or loss when it's all done. Anything that was more than a year is considered a long-term transaction for tax purposes. One wrinkle for option buyers that you have to take into account is that exercised options are treated differently than options that are sold to close or that expire worthless. Options that are exercised go towards an adjusted cost basis if you exercise the calls that you owned, or an adjusted sales price if you exercise puts that you were long. Let's go into that and show you what I mean. Here's some examples. Suppose you bought to open some January 10 calls for $1 a share. If you exercise those calls, your cost basis becomes $11, the $10 strike plus the $1 you paid for the option. So you now have an $11 cost basis. The option by itself is not reported as a separate transaction, it just disappears. Your holding period for the stock in question would begin on the exercise date that you exercise that call, not the settlement date, which is T plus 3, and not the date when you bought the option. It starts when you actually take possession of the stock by putting that exercise in with your brokerage firm. If you bought to open $10 puts for $1 a share and then you later exercise them, your sales price is reduced to $9. That's the $10 strike minus the $1 you paid to sell. So that you really got $9 net, and that's what you would report. The option, again, is not reported as a separate transaction, and your sales date for that stock is the as of date of exercise, not the settlement date for that at T plus 3. For option sellers, it's kind of the flip side of what we just described. Calls that were sold and then exercised by the buyer of the call premiums get added to the strike price for tax purposes. Puts that were written and exercised by the buyers of the options go towards reducing your cost basis if those are actually used. In each case, the original options transactions do not get reported for tax purposes as separate trades at all. And I'm going to give you some examples to make that easier to understand. Here are my examples. Again, sold to open January $10 covered calls at $1 a share. If somebody exercised those and called your stock away, your adjusted sales price would be $10 on the strike plus the $1 for the call. It's as if you sold the stock for $11. If you sold to open January $10 puts for $1 a share, if those were exercised, your cost basis would become $9. How did we get 9? We took the $10 strike minus the $1 you received for the put, and your net cost basis would become $9. The original option trades would no longer be reportable for tax purposes because they were exercised. Under certain conditions, the extra money from the option sales can turn into long-term gains, but that's a little complex, and I don't want to get into the exact details of that right here. So, what do option sellers need to know? Here's the basics. Anything you sell short has no holding period. If you sell short stocks or options, you don't hold it at all, you shorted it, and so even if you stay short LEAP options for more than 1 year, you can never get long-term tax treatment on those options per se, because you can be short a LEAP for up to 2 years, but you never held it, and so you can never have a 1 year and a day or longer holding period. Options only become taxable when they are closed or they have expired. So, if you have an option that you close, then you have to report it. If it expires, you have to report it. But if you wrote options that expire in the next year or the 2 years from when you wrote them, for instance, it's 2011 now, but you can be writing LEAPs for 2013, you could have a major benefit because you get paid now and it doesn't become taxable for 1 to 2 years later if you pick those long expiration months. What are the major benefits you can get from option selling? Well, when you short a stock, your brokerage firm will hold the sales proceeds in a separate sub-account. It's called a short account. And you don't earn any interest on the money generated from those short sales. So, you've generated a lot of money to the broker, but they don't pay you interest on it. They keep the interest. If you short calls or puts, that cash comes into you unrestricted, and you can earn credit on the float from other people's money. This can be a very big thing in times when interest rates are higher than they are today. At times in the past, I've had enough millions of dollars in float from sales of options where I could make $10,000, $20,000, $30,000 per month just in interest on the float. It's hard to do that now with interest near zero, but the day is going to come again when that float becomes very, very valuable to you. If you short leap options, as I mentioned in the slide previous to this, that expire in future years, the money is credited right now while all the tax implications are pushed into later years. And if you're profitable and successful in your option selling, that means that in essence, you're getting paid now with tax deferment from 1 to 3 years. Now, how do you get 3-year deferment if the longest leap options go out right now to 2013? Well, if you write an option that expires in January of 2013, when do you actually report it on your tax return? In April of 2014 when you do your 2013 tax return. So if you sell a leap for 2013 today and it expires in 2013, you won't actually pay the tax on that transaction until you file your taxes in April 2014. That's more than 3 years away from today's date. That's a very nice benefit. So let's wrap it all up for you. What have we learned today? We've learned that purchased options are treated pretty much just like stock for tax purposes unless you actually exercise them. If you do exercise calls that were long, not long in date, but long that you owned, they add to your cost basis while being exercised, and long puts that you exercise decrease your reportable sales proceeds. That's just the way the IRS requires you to do it. It's not your choice. That's what they tell you you must do. Shorted options, or options that you sold, become taxable events only when they are closed out or they expire worthless. So again, you can sell an option in 2011 that expires in 2012 or 2013, and it won't become a taxable event until it's closed by you or they expire worthless. Short put options that get exercised go towards decreasing your cost basis, while exercised short calls end up increasing your sales proceeds. LEAP, or the long-term equity anticipation options, held for more than 1 year. These are the ones that you actually bought. If you bought them and held them for a year and a day or longer, they can get long-term tax treatment. LEAP options that you sold short to start can never qualify for long-term tax status because they were never with a holding period. Shorting options can legally defer tax reporting for up to 3 years, and if you have good success in your option strategies, this is a major benefit. Thanks for joining me today. This has been your host, Dr. Paul Price, for Options Profits.